Welcome everybody to this evening's information session where we are going to be presenting our latest bespoke US dollar income note. This note is exclusive to Cashbox Global. For newbies, my name is Jill and I take care of the investor community. We also have Andrew, who heads up structuring for Cashbox and is the mind behind this note. Logan's going to be managing the chat for us this evening, and we have Chad dialing in from sunny Mozambique. Please feel free to post your questions in the chat as we go along. And for those that are new to structured notes, if you do have any questions about what they are and how they work, just let us know and we can arrange a training session. With that, just first some housekeeping as always. Our session today is to introduce our latest income opportunity and explain how it works. It's intended to be educational and doesn't constitute personal investment advice. Structured notes are not risk-free, and outcomes depend on the terms of each contract and how the markets behave. And this is why education is so important. Always make decisions based on your own research and professional advice where you need it. With that, I'm going to hand back over to Andrew.
Thanks very much. Thanks, Joel. Thanks for everybody for tuning in tonight. I was joking when I said I was in the pool and having to leave my drink and get dressed. Joel and I were scrambling around getting slides sorted out with busy days. It's quite a brooding sort of presence, that picture that you're seeing on screen. Joel was saying to me she asked AI to produce a German style or inspired type of bridge that is very common in Germany. I spent some time there and I can certainly agree. I've seen big bridges like that. And certainly the spires across the river, it reminds me of Cologne. And some of the spires were spared during the Second World War from the Allied bombing on Germany. But truly, there's some remarkable architecture that survived and still thrives today. So let's get to it. It's a memory income Autocall based in US dollars. It's got this really top line, thank you, Graham and IDAD, for securing a 17.65% per annum quarterly coupon, paid quarterly at 4.41. So that's a coupon we haven't seen for some time. It's really quite fizzy, as we call it. It is conditional. It's not a fixed income, and we'll go through. Joel will take you through the conditions lately. There's some lingo at the top there, as Joel mentioned, for new people. 55, 65. What does that mean? She'll take you through that. But it's a memory income note, and I did pop out to those of you who are on our Cashbox community WhatsApp group that as of this afternoon, it looks as though we're around about 60% of allocation of inventory taken up. What I mean by that is that Graham and the team put together an allocation, an amount, an inventory, capacity, whatever you want to call it, what's available on the shelf, and 60% has gone since we literally sent out the invitation, the term sheet, and people have had a look at the rationale. And I think Logan is putting both those documents. They are links on the hyperlinks on the invitation, but they'll be in the chat as well tonight. So let's get into it. It does close Wednesday, yay, on the 25th of February. But or this inventory that I talk about. And typically, we always say this because we always seem to run shy of inventory, and it's not certainly a salesman trick or saying, get your orders in. Think about it. As Jill said, I always end my weekly wraps by saying, have a sage and profitable week. And part of that is thinking things through, thinking where things fit into your requirements, into your world, into your paradigms. But it's a defense stock. This is our second one we've launched. It's slightly not defense. It is defense, but it's not defense. And I'll show you, and I'll illustrate why it's not pure defense. We launched one last year, around about May last year. And pretty much, again, that was a growth note, and pretty much that has behaved exactly to the parameters that we were expecting. And this is obviously a big, big theme. I would urge you to read the rationale. It's understandable, hopefully. I do it on a Sunday morning generally when I'm nursing a coffee, nothing else. And I try and make a lot of sense to a lot of people, hopefully. So let's move along, because this is the sort of we always have, who is the bank and what's the underlying story? What's the reference story? What are we linking this? Is it a theme? Is it something that has resonance? What are we looking at when we talk about defense? So BBVA, many of you will be familiar with the Spanish multinational investment bank. Very, very experienced in structured notes and putting deals together with IDAD, our structure. And there are a couple of names that may or may not be familiar, beg your pardon, to some of the people on the call. These are big companies in terms of size, in terms of dominance, in terms of geographic location, and in terms of, I mean, I was absolutely blown away this afternoon. Somebody said to me, a client said to me, this Capgemini company, which is a French company, IT company, essentially, that's obviously diversified into the defense space. They said, how many people does this place employ? Well, I thought 400,000 was a lot of people. Okay, and that's their staff complement. 400,000 people globally. A lot of them hub out of the Indian, the subcontinent. There's a big operation that runs out of there. And then I started thinking to myself, so I'm digressing a little bit. I started thinking to myself, 400,000 people is a lot of people. When I started comparing it to some of the other employee numbers in these businesses, and these are major, major global businesses. And then I just idly Googled, because I haven't still got into the AI thing. I idly Googled, who employs the most people in the world is in a private enterprise? So there's something we're going to look at. It's a retailer, and we included it in one of our notes recently. I'm one of those people, I'm like the Grinch, I always take the fun away, so I'll tell you who it is. It's Walmart. They employ between 2.1 and 2.5 million people per annum. Some are seasonal, so they come in and out, hence the moving number. But I thought, like, man, that's a lot of people. McDonald's, I think it's I wrote them down here, 1.5 million people globally, worldwide. So 400,000 kind of pales now. I don't feel so, wow. But it's quite interesting. So there are two real, I would say, military defense-orientated companies here, and that is Rheinmetall, German company, out of Frankfurt, and Leonardo, which is based out of the US. It's the only sort of European company, and there's a big focus on Europe here. And then you've got ThyssenKrupp, which is a very large global, but German-based industrial giant, and defense is one of their sectors. And then Capgemini, based out of France. So we've got 3 European companies, and we've got a US one thrown there for good luck. Pretty much the same composition like we had for our previous note, in terms of the makeup was more towards Europe. And there's this definite understanding of why Europe is obviously the flavor at the moment, given our next slide. So this goes back, I've taken some slides back to 2018. Jill, if you want to just move along the slide. Here we go. So we used this slide in the last presentation, so some of you may have seen it, but I've headed it, is there truth in the rhetoric? And if you look at some of these comments and some of the narratives that have come out of Donald, going back to 2018, there's some truth in some of it. And in many respects, it's made Europe very introspective in terms of looking inside itself and saying, well, hang on, maybe we need to lift ourselves up by our own bootstraps and create our own economy, because Europe has been in a quagmire for, well, I won't say before COVID, but certainly COVID pushed them down there, and they haven't really sort of popped their head above the parapet for quite some time. They've been pretty stagnant compared to, let's say, the United States. And he's had some very valid points in terms of the subsidies that America has paid for the defense of Western Europe. And he said if it's not fair, and if it wasn't for us, NATO wouldn't exist, and we'd all be speaking German or Russian or something or other. But he did make some very pointed questions that you guys across the pond need to actually get your act together and start defending yourself. Now, maybe a little unfair, because Western Europe, to a large degree, has emptied its cupboards and its war chests for Ukraine. Yeah, so has America, but it's become a little bit more tricky with the change of administration from the Democrats to the Republicans. So Europe has been far more steadfast in terms of its support. But basically what's happened is that the tank is now kind of running dry. And if this European war, this Eastern European war, drags on as it seems to be, it's creating issues. So in my narrative of the rationale, I just say, Vladimir Putin and Donald Trump have caused Europe the same problem. One from rhetoric and one from the act of war, to basically say we need to protect ourselves because the changing dynamic of US support might actually not be there when it's needed if the Eastern Europe did decide to go further after Ukraine. So these are some of that's a little bit of for context in terms of, there is some truth in the rhetoric. It's taken the Europeans to wake up some time. There's been a lot of, if I can put it quite bluntly, a lot of bleating, and we have special relationships, and we the French, and we export champagne, and we Scottish, and we export whiskey, and X, Y, and Z. And tariffs came along last year and threw everything out. And I think that was a real wake-up call from a business perspective. Donald Trump is a transactional president. Simple as that. He's a deal maker. We all know about it. Whether you call him a deal maker or the taco king, Trump always chickens out at the last minute moment, and then makes a U-turn and does something else. He's very mercurial, but he's a transactional president in terms of he wants to make things happen, and it's done on the deal basis, a deal broking basis. So I've tried to take this presentation tonight in a slightly different mode, as opposed to saying we've got 4 wonderful companies, which most of them generally are when we research them, and rather look at it from a point of view of, let's look at this as a business opportunity. Let's look at it from Donald's output from behind the Oval Office, in the Oval Office, from behind his big desk, Abraham Lincoln's desk, and say, right, let's follow that famous mantra, follow the money. And I'm going to take you through some slides to show you where that money is coming from and where it's going. So if we go to the next slide, and this is again a slide from the previous presentation, that's really a picture of NATO, what NATO looks like, okay? On the far side, you've got Canada and the United States. I suppose they could go to war at any stage anyway, but they hate each other by the sounds of it. The 51st state, or Canada fiercely independent. Greenland's not on there, but Greenland will feature just now. But that was the situation in May last year. It hasn't really changed. NATO still exists. It came out of a creation of a buffer against what was known as the Warsaw Pact countries, Eastern Europe and Russia mainly, the Soviet Union following World War II and the defeat of Germany. And it's always been there. So the major superpowers are all in play here, even China, and we'll get to that. But that's how it existed, okay? But across the waters, you call it across the pond in the previous slide, he talks about we've got this great, beautiful pond between us. America has always been this, the big brother, as Mark Rutte called Donald Trump in one of the famous meetings. You're the big daddy with a big stick, which caused a lot of humor. But America has always been the ally of last resort should Western Europe be attacked. Many of those countries that you're looking on screen are armed with American weaponry, with arsenals, assets that are American. They need American spares, American servicing, American parts, etc., training. And that's been probably one of the fragmentation problems of Europe, is that there's been this heavy reliance, almost a well, I'm just going to let the Americans sort this out if there's a problem. And Trump probably poked them in the chest and says, you need to sort out yourself and wake up. So hard lessons and real lessons are sometimes the best lessons. They're hard to take on board at the time, from a pride issue, from whatever issue you might be looking at, but it's a reality. And I'm keep coming back to the story of, let's look at it from a businessman's perspective. Let's look at him as a deal maker and transactions. So what happened? If we go to the next slide, please, Jill. It's all about spend, spend, spend. Okay. And in 2025, the US was spending a huge amount on its defense budget. Now, I'm talking about its global defense budget, not just Europe. I'm talking about the South China Seas. We're talking about Taiwan. We're talking about now South America, which has become this hot spot through Venezuela. Maybe toned down a bit. I think the Armada has left. It's probably sitting off Iran now. So there's this constant moving geopolitical situation where America is either seen as the bully boy of the world or the policeman of the world. But it was spending 3.5%, 3.4% of budget. What was the European guys doing? And if you could just fly in some points here, Jill. I'm speaking to just a flag. Okay, there we go. In contrast, you've got NATO and Canada, Eastern Europe, Western Europe and Canada spending a lot less. So hence Donald is saying it's not fair. You guys need to spend more. It's not up to us to defend you every 5 seconds. It comes back to this point where NATO really abrogated their responsibilities. They sort of said, well, we've got America as a backstop. If we need a problem, we've got a big gorilla who'll come in with a baseball bat and he'll take out the Russian bear. Russia, if you look at those numbers, has surged. China, 566 since 2000. So they are going almost onto a war economy. And if we go into some of the budgets, China's budget is set at 253 billion. Okay, look at the top number, 1 trillion. Okay, with America, they're spending 1 trillion. So you think like, well, that's not much. You think about purchasing parity here. There's something I looked at quite carefully because I thought that seems way out. It's actually around about half a trillion, because manufacturing in China is so much cheaper. The same goes for Russia. They've reorganized their entire industrial base, become a war economy. So if you look at the next point, Russia's budget is set at 156 billion, but in real purchasing power, it's around about also half a trillion, as they've moved into this war economy sort of footing. So everybody is spending, and there's NATO, those blue countries, saying, the cage has been rattled now. Maybe, it's all very fragmented because we all do our own thing. We need to start talking. And then in 2026, along came the Greenland issue. Along came the NATO issue again, and Davos, Switzerland, where it all kind of went down. And per, what was his name? Gavin Newsom, who's the governor of California, who was a fierce critic, a vocal critic of President Trump. He said, you guys need to grow a spine and get off your knees. Interestingly enough, I was listening to on Reuters a call this afternoon with Emmanuel Macron. Not that I was on the call with Emmanuel or Mr. Macron, but I was listening to one where he said Europe needs to become a global power, which is very interesting. Not a regional power, a global power. Nobody's spoken about Europe being a powerhouse. That's where all the wars started. That's where they always sort of come from. But now there's a change in sentiment. But yeah, along came Greenland. Trump said it's necessary for American defense and for strategic purposes. Never mind, we won't go into the minerals, we won't go into anything else. And he says, NATO again. They said, well, hang on, this country belongs to Denmark, which is part of NATO. You can't just march in here. You can have some more air bases if you want, but you can't have it. He says, no, I want it. Let's do a deal. Let me buy you guys. I'll give you each $166,000, every single person, man, woman, and child. And the Danes didn't like it, and Europe suddenly stiffened up, talking about the backbone. And, there's jokes about a couple of Inuits and a few Huskies and maybe a couple of polar bears arming themselves to the teeth and trying to protect themselves against the Delta Force team that comes in from the States. And let's throw the Danish, one of the biggest Danish companies around it, and let's build a wall. Let's build our own wall out of Lego. So there was jokes about it. But at Davos, and I mentioned that in the earlier slide, it suddenly stopped. There was a meeting with Mark Rutte and a few other off-screen meetings, and it suddenly went very quiet, and Trump got onto the plane. The whole Greenland thing de-escalated for now. De-escalated. And everybody said, oh no, he's come to an agreement. They'll have some more bases. They'll have listening posts. They'll have their submarines there. We'll all get involved. Happy days. It wasn't really explained. So I belong to not a think tank, but I belong to an organization that does a lot of think tanking through The Economist, which is a very, I would say, conservative, sage, responsible periodical. And they've come up with some, obviously, feedback, anecdotal, etc., in terms of why did America suddenly change its tune on Greenland. There's no mining agreements. There's no fancy this. It changed because the Europeans grew a spine. And what the Americans didn't realize, well, they did realize, but they didn't think the Europeans would bring this up, is that America has this debt problem. Okay, it issues US Treasury bonds to cover its debt. In other words, it funds itself. Every 5 minutes, it's reorganizing a refunding of the US government. If we go to the next slide, you'll see the top foreign holders of US debt. Okay, these are the guys who buy American Treasury bills. And this is what keeps America going, quite frankly. And we've seen a couple of shutdowns recently. It was a very short one a while ago, and the longest one in history was about 43 days, which was at the end of January. So it's a problem. You've all heard this thing of them kicking the can. Every administration kicks the can down the road. So have a look at that. Those are the foreign holders of debt. This is where leverage came from in terms of forcing the Americans to back down on Greenland. So says The Economist. If these guys had to start selling their bonds in a coordinated fashion to create this leverage, they could probably send the American market, the economy, back to a 1929 economy. And we all know what that was. That was the Great Depression. Because the economy would effectively falter. it would cause chaos in those countries that have bought the debt, okay, because they're obviously living off it. But America wouldn't have the interest bill being serviced if they said, here's your debt back. It would create massive threat. And this is where the leverage came. And the leverage came in terms of, for the defense theme and these companies of Europe, is that the European leaders got together and say, we need to re-employ some of this money, even if it's a fraction. Over time, if we sell off, not double down, but if we sell off portions, we can create a massive liquidity pool to basically refund our infrastructure and our defense capabilities and our shortfalls, which are great in terms of obviously also the cupboard's bare with Ukraine, and still keep America in tandem with us. So this was one of the major points that really hasn't percolated as a concept yet, because I did mention Trump is a transactional guy. He has a book called The Art of the Deal. This deal got him, and he didn't know quite how to deal with it. And his advisors, Scott Bessent, Secretary of Commerce, and some others said, we need to back down off this. It's not popular, but it's also going to hurt us hugely economically. So those are big numbers. If you look at those numbers, we're talking billions here, okay? And NATO and Europe are under threat. And now what's going to happen? So let's do some scenario planning here. And this is where the seed of this note came from in terms of our thinking. So in the next slide, you'll say, is this a compelling case to follow the money? Okay, it's a famous saying, follow the money, and you'll find either the bad guys or the good guys, or you'll find who is in the food chain, okay? Who's got their nose in the feeding bag. And here's the scenario planning. In 2025, the EU defense, and I'm talking now about buying tanks, jets, corvettes, submarines, fins for frogmen, all that kind of stuff. 393 billion. That's a lot of money. It was ramping up significantly in 2025. This has been going on since 22, when Russia invaded. That war's been going on nearly 4 years. That ramped up, but 2025, nearly 400 billion euro. And many of these defense companies have done spectacularly well because they were in the right place. They were always a bit of an unloved area because America was always there. So there's an agreement now, post-Davos, post all this saber rattling and cage rattling by Trump, is that we need to get to 3.5% of gross domestic product for your defense allocation. In other words, whatever your country is producing as a domestic product, 3.5% must go towards funding your own sovereign defense or contributing to this EU defense package, okay? And European Commission, so if you're part of the EU, you've got to play by their rules, okay? England didn't like it, they Brexit, but they're still there, they're still part of NATO. But the European Commission has this it's called RE30, which is Readiness 2030, which is a plan to mobilize up to, before 2030, 800 billion euro through new financial engineering, through new loan structures, through new leverages and loan instruments, to create funding available for defense and, most importantly, infrastructure, okay? And to buy European. That is most important. Do not buy something from China. Do not buy it from India. Do not buy it from Australia or the States. Buy it European. So this fragmentation I've spoken about, they need to bring it back home. And that's a lot of money. That's got to go somewhere, okay? And you talk defense and you talk infrastructure. And that's why this note is a little different to the previous one, which was more defense-orientated in terms of hard military assets. These are companies that are industrial companies as well as IT companies in terms of the IT space, but they're all linked into this defensive net, okay? And there's a very interesting slide on one particular German company I'll take you through. I've spoken about this sort of European quagmire. Europe hasn't been going anywhere fast in the last 5 years, ever since COVID, quite frankly. The economic situation has been very, very dire. Your returns haven't come out of Europe. They've come out of America in some instances, the UK, and more recently Japan and places like that. But where's that money going? So follow the money. So let's think like businessmen now, okay? Let's think like savvy investors, as we always say. Fact, buy European, okay? And this is what is changing now. The value of procurement contract just last year, in 4 or 5 months, doubled, okay? They took it on board. They said, okay, we've actually got to buy from each other, okay? We've got to work together. And it doubled from 131.8 billion to 240, or it didn't double, I beg your pardon. It just went up rather substantially to 245 billion. So $250 billion US dollars effectively was spent between these various countries, these sovereign governments, okay? And 53% of that went on European systems. You can't just cut the American umbilical because, as I mentioned earlier, most of those air forces, most of those armies and navies are equipped with American supplied equipment, backup, training, servicing, you name it, supplies, engineering, factories, it's all geared for. So you can't just say, well, we're getting rid of our F-35 Raptor fighters and we're going to bring in a Saab Gripen and it's going to do its thing. It'll be a changeover. So some American companies are starting to squeak a bit because they know down the line, instead of just having the latest updated helicopters, Black Hawks, whatever it might be, or the latest F something fighter jet, they might be losing those contracts to European. It's a bit like what happened with Boeing. You know, Boeing was the plane, and then Airbus came along. Okay, Airbus is European. All the components come from different parts of Europe, and it became a major competitor to Boeing. Okay, McDonnell Douglas and people like that. So this is kind of the thinking where Europe is going to try and get out of this economic quagmire by actually using all this money that's going to be sloshing around to basically reignite its economy. You know, it happened a little bit in after the great financial crisis, where the central banks had to do what was called quantitative easing. They had to put money into the system to keep people afloat, to recapitalize, to have capital expenditure, to get things going. This is another sort of version of it, okay? But this is being done by sovereign governments in tandem with each other. So, you know, this switch, as it's just flown in now, is primarily on European-based military-industrial complex companies. So that's actually a term that's written in all sorts of economic, handbooks, in a lot of political handbooks, the so-called military-industrial complex. Those are companies that work in this military defense space, but they also have revenue streams coming from outside of just pure defense. So, you know, you get a company like McDonnell Douglas. It builds fighter jets, okay? You get a company like Boeing. Yes, it will produce the turbofans for the B-2 bombers and all that kind of stuff. But they also have commercial liners, so they're in that other space. We've got some companies here that, yes, have military earnings. They have earnings coming from military projects that they're involved with. But they also have projects coming from outside. Question that I posed myself, and I'd posed, was that all this money sloshing around, it's not just going to go to bullets and canteens and that sort of stuff for fighting men. It goes well beyond that. It goes into infrastructure of all these fragmented countries having access to one another, of getting things there quickly. So if Poland got invaded, are there railway tracks to get German Leopard tanks there quickly? No, they're probably not. You're going to have to start building railway tracks, bridges. You're going to need steel. You're going to need cement. You're going to need pharmaceuticals. You need IT. All these type of things. So these hybrid type of companies are very well positioned to maybe get some of these orders, and that's what it comes from. If anybody's in business here, you know, if you get an order and you do it right, you're going to get earnings, and if your costs are below, if your inputs are below what your outputs are going to be, you're going to make a profit. So that's the concept behind this. It's not just following who makes the best jet or the best helicopter or the best drone. This is more about, yes, that's a feature of the earnings of these companies. But let it also be an understanding that all this money that's being pumped into Europe is going to go into other projects as well. I mentioned this word military-industrial complex. It sounds high level and senior grade or high grade, whatever they call it at school now. But actually, it's and it's on the next slide. Actually, the defense sector has become, like everything in life, it's become integrated into so many other sectors. It just doesn't sit as an aside on its own, isolated in like a laboratory. It benefits from those synergies and those opportunities with all sorts of other sectors. And that's known as that military-industrial complex. And you can read it there. You know, construction, I mentioned, railway lines, bridges, airports, harbors for submarines or corvettes, refueling areas for fuel, logistics, supply chain management, etc., 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 etc. A key a key takeaway or a key learning that has come out of the new AI war, if one wants to call it that, which is really emanated out of the Ukraine-Russian conflict, is that you have to move very quickly. This is not World War II, where you have committee meetings. You have to move very rapidly. You have to be very innovative. And how Europe is set up at the moment, you need a lot of high-level governmental agreement that governments are going to work together very well, where they cross-subsidize, where they work together because they need to work and they want to work together. So yeah, there's a more of a breakdown of the individual companies, in the rationale. But I want to concentrate on two companies, or one specifically, but two are German. Okay, on the right-hand side there you see Rheinmetall and ThyssenKrupp, very big companies, big established, lots of employees. I think Tyson's 100,000, etc. So if you move on to the next sort of slide, it's really just a bit of a focus on why Germany. Well, Germany is the most populous nation in Western Europe, okay, on the continent there. And these are two heavyweights. It's got the biggest economy. It's probably got the most capitalized stock exchange through Frankfurt. And not because they're a belligerent nation or have been a belligerent nation in the past, but they are seen as a bit of a warrior nation, and they expected almost to take the lead, being that close to, let's say, the Eastern Front, if you want to call it the Eastern Flank. And in terms of that, Germany has, it's also gone through some quite rough times politically. They've had a change of government, a change of political bias in terms of elections. But they are wanting to spend 5%. Now, that's way above the 3.5 that Trump was asking for and the EU Commission agreement is on. That's a lot of money, 5% of their GDP. But again, Germany, like the rest of Europe, has been quite mediocre and quite slow in terms of its delivery of profits to shareholders in the private space. But their budget, you can see there, 2025 and to 2029, and these are estimated figures, these are proposed figures. You can see the ramp up. There's a lot of cash coming into the system, okay? And follow the money again. Where's it going to go? It's going to go to building and solving all those shortfalls that currently exist in this fragmented NATO, fragmented Europe. The German government, for example, for many years has had what's called a debt brake, something that the Americans have never heard of because they just print more money to fund their debt. The Germans have said, no, if we get to a certain limit, we can't go past it. You can't spend any more money. No increases, no public offerings. That's it. We were stuck. And they said, hang on, this is more serious. And they actually passed legislation to show that we would release that debt brake, if I can call it that, to allow this money to flow, these annual increments to flow into the German budget to get up to that 5%. So they're very serious about it. So they are slowly moving a lot of their businesses into what Russia did 2 years ago, into what's called a war economy. In Russia, there are a lot of things going wrong. If you look at the amount of men who've been lost in that war, the amount of injured people, the amount of sacrifice that maybe the average Russian is having to make for Putin's, imperialism. And I won't get started, but there are difficulties there, but they're on a war footing, okay? And that's why there's no rush to sign a peace treaty. But this industrial base will close those capability gaps. And if your company is not just purely defense, if it's got some angles into, let's say, construction or steel or energy, surely that you could be in line to get some of those orders and some of those earnings and equals profits. So let's have a look at ThyssenKrupp. It's a steel company. It's an energy company. I've taken this is, as I said, Jill and I were running around just before we started. I took this off my phone, so apologies for everybody. It's not a fancy slide. It's data from Yahoo Finance on stocks on my Apple. But it's a 10-year report, okay? Quite interestingly, sort of near the top there, it's in red, it says minus 15.87. That's the 10-year. What has it done over 10 years? So over 10 years, it's actually gone backwards 15%. Okay. So we've got great defense levels built into our note. There's that 55, 60 that Joel talking about, but be that as it may. And I took a stab and I centered round about where COVID was. That's where that little line, it says 870, 24th of February. It was about a week later. It was around about March that it really got going, the COVID drama. But you can see it was on the downhill slope in 2020. Look where we are today, and it was 870 there. It's around about 1180. So it's kind of gone sideways. You can see the stochastic line. It's just sort of meanders around. Interestingly, since 24, it's started moving up. It's got its volatility spikes and its ups and downs, but it started moving up. Interesting also is that it says earnings report there. Now, I'm a big believer in earnings report. These are the quarterly earnings report that the companies who are listed are obliged to report to their shareholders and to the market in terms of how well did they do or how badly did they do and what went right and what went wrong in the previous quarter. So that will be quarter 4 of 2025, which by all sort of reports was a very, very strong quarter for this particular company. The company also gives guidance in terms of the executives will give guidance in terms of how they see things panning out. And this is on both sides of the pond, whether you're in the NASDAQ, the S&P, the Dow Jones, the UK, you all do these sort of things. But I look at it there's quite a lot of work that goes into this company. So this company at first blush looks a bit boring, looks like it's battled, hasn't really done. So as a growth company, it wasn't a great investment in 2020 because it's gone sideways. It's easy to look backwards now. But structured notes aren't in it for growth. We're in it for, we as long as it sort of stays sideways, a little bit down, we're happy. We've got this deep income protection level. We can go down to minus 45 of a price. So, it's only lost minus 15. That's to generate this 4.4%. I get really quite excited, this income. So a lot of protection, a lot of opportunity to trigger those conditional coupons. So well done, Graham, well done, IDA, and well done, certainly the investment bank, who collectively agreed on this contract and underwrote the contract. Now, I look at some other things, some key metrics. I'm not going to bore you because I can get very technical and you'll all glaze over and reach for your wine or coffee or whatever you're doing at the moment, or turn me off. But I keep mentioning it's not really about, this is a company that's diverse, it's diverse, hugely diversified. Steel, energy, it's an automaker, it makes cars. A lot of its income came from cars last year. It provides cars, steel to manufacturers like BMW, Mercedes, etc., Porsche, Audi in Germany particularly. That's got competition from the Chinese. But do you think the German government's going to give the money to the Chinese for cheap steel? That defeats the object. That's what it said. It's got to be European. That is the agreement from the EU Commission that you need to buy from your own people. Okay, not go and buy cheap Chinese products. Okay. Interestingly enough, the Chinese, with their cheap cars that they're flooding Europe with, wanted to take over some defunct VW sites in Germany, which had been mothballed because they weren't very profitable. And it all fell out of bed because Rheinmetall, one who make tanks and interesting things like that, they're a pure defense company, they're the German company. They went in and said, hang on, this is a production line. It makes Polo cars. We can make tanks here. We just have to do a few things, get some clever people in, and we will start churning out tanks and exporting them to our fellow NATO members. And that's actually what's happening. There's a fun slide at the end before I hand over to Jill. But I've looked at earnings here, and the earnings is on Tuesday, a big part on Thursday. Earnings report is on Thursday. The analysts, and I've been on various calls today, are all saying this is very much of a value play at the moment. So they think it's good value, and that it's a buy at the moment in terms of holding it. And we've got a 3 to 4 year contract if it goes that long. If it doesn't Autocall, we've got 3 to 4 years. So I'm very comfortable when they talk about those sort of earnings periods. Some of the technical stuff I won't get into now, but in terms of the price to book ratio, in terms of the cash flows, in terms of, if I take something like, what is your cash flow versus if you take your assets and you minus your liabilities, you can do this for yourself, even at home. Say, what am I worth? What do I owe? Is there a positive sign? If there's a positive sign, that's good. And if the ratio between what is left after taking the minus from the plus, if it's a reasonable one, and it's not too high, then life is good. You're okay. Against its peers, it's very cheaply priced. So we feel as an insertion into the basket, this was appropriate. This is not going to give you 20, 30% per annum growth. It's not nothing like that. You might get 3, 4, 5%, but that's what we're happy with. Okay. There is a little bit of risk, but there's no major, we don't feel major risk in terms of this. Revenues from cars is a big thing. And what happens if the Chinese cars come in? Well, they make more money out of selling submarines. And they've just signed a contract for 4, I can't remember the class of the submarine, for the Norwegian Navy and 2 for the Singaporean Navy. That's outside of NATO, but it's still great money. Now these guys have been going a long time. They've got a proud history and maybe an infamous history of building the U-boats in World War II. As you can see, I like history. But they operate out of Kiel. Their head office is in Essen, 93,000 people. So that's marine shipping. It's just actually been listed separately. They spun it out of the main holding company on Frankfurt. So it runs itself, but its earnings, they still own 51% of the marine division. So those earnings still flow through to its parent, Tyson. So we don't really have an issue with these sort of companies. So it's going to be interesting to see on the 12th of Feb how they pan out. And so to finish off, let's just have a pivot on a new meaning. And this was a slide from May last year. This was the example I gave where I said, the Chinese car maker, I think it was Geely and Build Your Dream, wanted to come in and take over 3 or 4 factories. And what's happened now is that the Panther, which is the main battle tank of NATO, besides the Bradley, which is American, costs around about $8.5 million versus a little VW Polo of about 12,000. So obviously you can churn out a lot more VWs, but you have to churn out a lot. And the government is going to be paying for this. They don't want more Polos on their road. They want tanks. They want tanks ready and able and willing to go to war. So whilst it's a fun situation, it comes back to this: where's the money flowing to? And we certainly believe these diversified companies are in a very, very good position. For a little bit of a deeper, granular exposure to what they do and how they do it, have a look at the rationale, and the fact sheet will also sort of take you through that. And I think that's my bit. I'm happy to take questions later, and it's over to Jill to tell you the more exciting stuff in terms of how much money we can make, hopefully.
Right.
Cheers.
Well, thanks for that, Andrew. It was really interesting. We're going to do questions at the end. So if you do have questions, just pop them into the chat. But in the meantime, I'm going to run through the terms of the note. So as Andrew said, the issuer is BBVA. There we have their ratings. Always tier 1, A-rated banks. We've got the coupon is 17.65% per annum, which is 4.41% paid quarterly, subject to the terms being met. The maximum term for this note is 4 years. And then we have an income trigger, this time at 55% of the initial level. Your autocall trigger is set at 90% of the initial value, and that's going to carry through for the entire term of a contract until it matures. The reference basket, Andrew's gone through those stocks, and our capital protection in this note is set at 60% of the initial level. So even if the underlyings drop by up to 40%, you're going to still receive all your capital back if the note runs to the full term. The availability is up until the 25th of February, or subject to full subscription. And as Andrew said, we're already sitting at 60%. I think people are learning, because the last few notes we've actually been oversubscribed. So the second it comes out, they like the look of it, they put their bid in. And then, as always, our minimum investment into the product is $10,000. So what I'm going to do now is I'm going to run through the various features, then share a few scenarios. So this is a 4-year note with along the top that you can see it is divided into 16 quarterly observations. The income trigger, as I said, is set at 55%, which means that as long as the underlying stock remains, all stocks remain above 55% of their start price, your income coupons are going to flow. We have included the memory feature, which has proven itself to be invaluable during the last period, which has been so volatile. And with the memory feature, if an underlying stock falls below the income trigger, any income that would have been paid isn't lost. Instead, it's actually held and accumulated. So when the market conditions improve again, and on a future observation date, all of the underlying stocks are back above that income trigger, you receive both your current coupon and any previously missed coupons. All accumulated coupons are then paid out altogether as a lump sum. This really reduces the pressure and the anxiety for everything having to go right at every observation. Next up, we have the capital protection barrier, which is set at 60%. And in the event that the note doesn't autocall and runs all the way to the 16th observation, as long as the underlying stocks remain above 60% of their start value, you're going to receive all your capital back. Then finally, there are the opportunities for the note to mature early through the autocall feature. This feature is set at 90%. Where am I? Yeah, this feature is set at 90% for the duration of the note, and it starts from 6 months, which is the second quarter. Should all of the underlying stocks be above 90% of their start price at any of the observations from 6 months, your note will autocall and mature early, paying out its final coupon and the full capital that you had invested initially. So moving on to some scenarios. Our first scenario here is at the first observation, the underlyings are above the income trigger and your coupon pays out. As we go along, at the second observation, one of the underlyings may have dropped below its start price, but still it's above the income trigger, so the coupon flows again. At quarter three observation, one of the underlyings has dipped below the income trigger. But remember, with the memory feature, that the coupon is now put on hold. It is not lost. Moving on to the next observation, your underlyings have recovered and are now back above the income trigger. And the coupon for that observation is now paid out, plus any of those missed coupons will get paid out. Then in this example, at some point in the future, before the final observation, all of the underlyings are above 90% of their start price and the autocall is triggered. Your final coupon is then returned together with your capital. So this scenario is the ideal outcome, and it means that your capital was never at risk and you didn't need to wait for the full term of the contract and run that full 4 years. So that is the first scenario. In this second scenario, the note doesn't autocall or mature early and it runs the full term. So having paid out all of its coupons, at the final observation date, you can see it's paid the coupons because it's all above the income trigger. All of those coupons have paid out. And then at the last observation, we have the capital protection barrier. The barrier acts like an insurance layer. And as long as none of the underlying stocks fall below this capital protection barrier, your full capital will be returned. So this can be considered an ideal scenario because the note didn't mature early, but all the coupons were paid out for the term of the contract. And then our last scenario is the one that we really aim to avoid. In this case, one or more of the underlyings has fallen below that capital protection barrier at maturity. The income during the term of the note will have been paid as long as all the underlyings remained above the income trigger, as I'd explained earlier. And because one or more of the underlyings have fallen below the capital protection barrier at that very last observation, observation 16, the capital repayment is now linked to the performance of the worst performing underlying. And it's paid on what's called a 1-to-1 basis, which means that any loss that underlying is reflected is directly linked to the capital that you're going to have repaid to you. So as an example, if this underlying has dropped by up to 45% or has dropped by 45% of its start price, dropped to 45% of its start price, 45% of the capital will be returned. And as I said, this is one of the scenarios that we really, really don't want to look at, but it's really in extreme circumstances that this scenario happens. Then, as you know, with structured notes, you have all the details up front in the contract, and that's listed in the fact sheet. And it also includes this page, which is all the important dates. Here you're going to find the observation date, the payment date, which is when your funds are going to leave the investment bank to your account, the income trigger level, and the autocall trigger level. You're going to remember that the autocall trigger opportunities start from the second observation in this note. Finally, you then have your capital protection barrier at the end, at the final observation, if an autocall hasn't been triggered before. So for anybody new on the call, all you need to access a structured note with us is an online trading platform, which is a custodial platform that holds the contract on your behalf. You can then invest, you can't invest through a bank account. We are platform agnostic, but if you do need guidance, you can just drop us an email. For those of you with the platform, let us know that if you would like to participate, and Logan will send you through the ISA number, which is that unique identifier for this particular note. While you can draw a report from your trading platform, we always provide quarterly reporting to keep you informed about your investment. Then, if you would like a refresher on structured notes, we're happy to provide any training and support, because for us, it's really important that investors understand how their investment works. Remember, the closing date for your funds to be cleared and your instruction to be with your trading platform is the 25th of February, subject to availability, so don't wait. And then we will make sure that you get into the note. And with that, we appreciate your time. Thank you for listening. And I'd like to open now for questions.
I think you've got some questions there, Jill, in the chat box. If I can I just quickly jump in on Ray's question about the foreign exchange? So thanks for the questions. They're excellent, and obviously Andrew and I will certainly be happy to address them. Firstly, Ray, as far as the exchange rate is concerned, remember that the underlying basket is effectively the engine to the note. So it is the performance of the basket, the individual stocks, that is driving through the defined parameters that will be delivered with regards coupon of the note. So you are putting dollars in, you are getting dollars back. You are not effectively exchange FXing with regards to your investment. The bank, as in, the provider, the counterparty, here being BBVA, is running that foreign exchange activity with regards to taking in dollars and then utilizing options with regards to the basket. So there's no exchange rate risk as far as you are concerned. You have dollars to invest. You will get dollars back, and it will be as per the defined parameters of the note, which is the contract that you are investing in. It is purely the performance that is in euros, and the bank is looking at that performance for the defined parameters that you will receive as regards to the note. So it's as straightforward as that. Have you got anything to add, Andrew?
No, absolutely. It really is as simple as that. Whilst they are global companies and they have revenues coming in from all 4 points of the compass, every structured note is a contract, and the contract is delineated in either sterling generally or dollars mainly. And that's the payoff. It's based in dollars.
Yep.
This particular one, the income coupons are paid in dollars, and ultimately the return is in dollars. The same goes for a question I think Victor put through. I did reply to him. I think I might have replied to him privately. He asked the question is the interest, if it's not paid, is it compounded whilst being held back in memory? So no, the contract is a simple interest. It's not compounded interest. So as Jill went through the linear sort of graphs, if a particular quarter elapses and for whatever reason the income is not paid, it's held back in memory. You have the sort of look back feature at the next quarter and say, right, now it's all performing, we grab it. But it would be the straight 4.4, whatever it is, percent, not any accumulated interest on top of that. So it's simple interest, it's linear, it's not compounded. It really is as simple as that. And it's all spelled out, I think, very clearly in the fact sheet. So hopefully that answers that particular question. Yeah.
Yeah. And then as far as Andres is concerned regarding the question on the basket,
Oh, yes.
I mean, yeah, again, absolutely a key question with regards notes, because that is the driver of the note. And I think from a very sort of like macro overview perspective, I would look at it from two points. You've got, and Andrew will obviously can delve into this at a later point, I think, maybe on a one-on-one, but you're really looking at DCF, discounted cash flow, and also at the PE ratios. And I think realistically, as far as the defense sector is concerned, these companies are running about par, if not a bit below what the sector average is, as far as the PE ratios are concerned. So I think really there's nothing that's shooting the lights out here. I mean, yeah, very valid point. Last 12 months, the stock price 3 out of 4 have roughly doubled. But again, I would take you back to the perspective that when we look at the stock markets, what are we looking at as far as the prices is concerned? This is future projections. We're not looking at the hindsight, although past performance obviously is relative, but again, it's not indicative of future performance. And as Andrew has eloquently pointed out, there is massive amount of cash going into European defense. The European Defence Fund, the EDF, is being bolstered with ginormous numbers. Because we know from what Andrew was explaining regarding the geopolitics, that Europe now effectively is armoring itself rather than being dependent on the US. And so therefore, and as Andrew again quite rightly pointed out, this is homegrown. So this will be from European defense companies. So this is all about the future, and these prices, I suspect, but again, nobody has a crystal ball, but these prices may well double again. But as I say, we do not have a crystal ball, but also the parameters of the notes are such that we've got flexibility there. Cashbox will always build this in, and so therefore a 55 trigger, level, a 60% capital protection barrier, coupled with a 90% autocall. We're trying to build in the flexibility, whilst utilizing a basket that everything suggests that we have a very robust and performing note for the term of its entirety.
Yeah, well said. Yeah.
Perfect. Okay, have we got any other questions? Don't see any new ones in the chat. Any last words, Andrew? We got a new one. Let's see. We got a new one.
There's another
What
one
happens
coming.
if the dollar crashes, which seems to be indicated?
Okay, well, I mean, I'll jump in there quickly. I know Andrew's got far more information on this, but I mean, very, very simplistically, if the dollar crashes, then yeah, essentially everything that's related to the dollar, you are impacted by. So it's global. If we see the dollar crash against your currency, then effectively so for example, I always look at the perspective that I have my dinner in sterling. And so therefore, if I've invested in a dollar note, and dollar crashes against sterling, then effectively I have that FX perspective to look at. It's where your money is. I'm not going to delve too much into it, but if you are externalizing your rands to go into hard currency, then you've made that decision. And if you invest in dollars, then dollars is your investment criteria. It's very difficult to give you a straightforward answer. I don't know whether you can clarify that, Andrew.
Yeah, so I mean, essentially, I think I like to, with a note, I compartmentalize things. I mean, depends what your base currency is. If you live,
Yeah.
if you live like Graham lives in the UK, he thinks about things in sterling. So if the dollar takes a tank and
Mm.
he's and he's paying sterling, it's happy days. His meal just became a lot cheaper. If you're an investor and you're using one of the major currencies as the reference currency, and that's what the bank does. I mean, BBVA is a Spanish bank. It could use one of 100 different currencies, but it only generally operates. Most of the investment banks mainly generally operate in one of the major, leading currencies of the cross currencies. So we don't generally see, exotic currencies. We normally see things like the euro, the pound, the dollar, and predominantly the dollar. It's the world's biggest market, it's the world's biggest economy. The word crash is, again, what is a crash? I actually did something on this recently, on I think it was a blog for Jill, in terms of, you have a correction, you have all sorts of different levels until you get a crash. A crash is something like quite fundamental. Is there a crash imminent? I certainly would not go as strong as that. I think the dollar's under pressure. I think, as you see, Mr. Trump is quite happy for the dollar to devalue. maybe his ego needs to devalue or deflate. But no, I think there's almost like, in some instances, it's quite good for a weaker dollar. Obviously, one has to think about his bigger picture of tariffs, imports, exports. It turns into a big economic discussion. But in terms of our investments, you're putting dollars in. And if you have dollars, if you've earned dollars and you've got the dollars and you put them in, you're going to get a dollar return. What that buys you in terms of parity, if you go to the UK or to South Africa or to some other country, that's where maybe you say, well, hang on, I'm actually losing out now because I'm having to pay more. And the same goes, the dollar's been very strong for me for a long time. It's been, the primary economy of the world. It still is. Everything's still quoted in dollars. It's not quoted in Bitcoins or Ether or something like that, which everybody thought was going to happen overnight. So I think there's always this. There are structural deficiencies and there are structural constraints in the United States financial system. It's going to be interesting to watch, and it's part of the discussion in terms of, economy and finance, is that they're going to have a new Federal Reserve chairman who's supposed to be agnostic and independent of politics, even though, this is the Trump sort of front runner. So there's a lot of things that's going to go on. The primaries on at the moment, the midterm primaries on, and the midterms come in November in the United States. So he needs to concentrate on his backyard and get the American economy working and people happy and prices down. So there's a lot going on. So I don't see the US dollar crashing. I see it going through a period of volatility, and there are a lot of technical indicators we could talk about, which, again, we chase our tails a little bit and go around in circles. But in terms of the investment, it's what you put in, you get out, and you get it in that currency. It's when you take those proceeds and you allocate it somewhere else.
Exactly.
If you now say, well, I'm going to go into pounds, and the American currency has devalued, then it's going to, hang on, I'm really paying. This is expensive now to go into a different currency.
Yeah.
So often it depends on what your base expenses. A lot of clients are saying, look, I have expenses in pounds, so I only want to invest in pounds. I don't want to invest in dollars because it's the FX change. I lose quite a bit if I'm going to service a pound debt with American returns. Yeah.
Actually, you raised the sterling there, Andrew. There's the questions there from Ray and Andrea that are raising the point that what about euro? What about GBP? Again, that's Cashbox decision to identify if they want to have a note denominated. Obviously, you guys have done this in the past. Whether you want to have a note denominated in different currencies, again, that's a marketing perspective for Cashbox to consider. I think if you're trying to utilize the notes to have an FX play, then that's a different question. If an individual is looking to seek out sterling denominated notes because they have an FX perspective, that's a totally different scenario that you're looking at. Cashbox can readily provide a GBP or a euro denominated note. It's a question of whether they believe, from a marketing perspective, it's a business decision that they should do. And then I think also that there's a question in there.
Sorry, Graham, I'll just jump in on that because I've had, and there's questions in the chat now about a GBP note. So our base, the demand is more on the US dollar side. So, we've got to commit to the hedge to create one of these. We need to be able to commit to at least £500,000 or more.
Yeah.
If we know that we have that critical mass, we can very easily create a sterling note. But unfortunately, at this stage, our base doesn't have that. We don't have enough people that want the GBP note. So, if we can get that number of people, we would absolutely do it. But at this stage, we don't have the demand, that high demand yet.
No, I think that's perfectly fair. That's a decision for Cashbox to make. I think Chris has raised a question which is very similar to, I think, what Andres was talking about. And again, it's about what you're looking at with regards to the basket and where you see that future projection. Because, as is the general ethos of the stock markets, you're looking at the pricing in the future. And you're looking at what's going to happen. I think the backdrop that Andrew gave with his synopsis and rationale is such that we have a sector here that is a massive focus as far as Europe is concerned. I mean, I go back to the point, the European Defence Fund. I mean, the Europeans are now Britain is now looking to buy into the European Defence Fund, because if we buy in, then we have our defence industry also able to participate in the in the generation of defence materials, etc. So if we don't buy into that European Defence Fund, then we cannot quote, we cannot bid, and our defence industry is precluded from the Europeans, so to speak. So it's, all of that is under discussion at the moment, and obviously it's massive. I mean, it's political, it's geographical, it's everything. But that sector, the sector that Andrew has identified, has a massive spotlight on it for at least the next 5 years and beyond.
Yeah. Chris, how's it? Good to hear from you. Just a quick one to add to what Graham said, which I endorse fully. In most investing convictions, they call it an investing conviction. You have to actually believe the conviction that when you're investing, that this is what I believe in. I've done my interrogation, etc., etc. So it's a very valid point what you raise. And yeah, it's not a cop out when one says, well, you don't know what's going to happen in the future. But one of the classical in investment, quantitative and qualitative analysis, I'm not one of those guys. I've done it the hard way, QBE, qualified by experience. I don't have all the titles behind me, but it's what's called a catalyst. And many analysts will look for this catalyst in terms of either a stock, in terms of a theme, a sector, an economy, a country, etc. In terms of what is the catalyst. Is there a catalyst, firstly? What is that catalyst? Does it have legs to survive a longer course or period of time, or is it going to end up like a pandemic darling kind of thing where it just lasts through a particular phase of the cycle? And what we are looking for, what we really have started focusing over the last year or two in Cashbox as well, is looking for these catalysts and looking to see whether the theme, if you want to call it that, this thematic approach in terms of this is defense, infrastructure, global military complex, etc. Is it secular or is it cyclical? Now, just by way of a description, cyclical obviously means it works in cycles, so it comes and goes. And it could go quickly, it could go very quick, could go very slowly. Secular is more like it's needed all the time. It's got longer legs. It's almost like a mega trend as opposed to a short-term trend. In investing, it's like you have a short-term moving average and a longer-term moving average, and somewhere between the two should be a happy space where you say, okay, I'm comfortable with those metrics that actually underpin the company. So yeah, it is difficult to say. Let's go out of defense. Are the Magnificent Seven, are the Metas and Amazons and Apples and Google's still going to be running the show in 4 years' time because they're also at all-time highs? Is Nvidia still going to be top of the pops in 4 years' time? So you have to take it back and say, well, what are they operating in? What is the cycle? What is the theme? What is the catalysts that are causing them to perform so well now? And is it going to be a long-funded approach, or is it going to be a short sprint? And I think, in terms of that tech space, for example, the big question, again, it's a big question around, is it an AI bubble? Is it going to monetize itself? Is it going to produce, the next sort of, is it going to be bigger than the internet, like everybody is saying? Is it going to be a threat to us? Is it going to be a threat to software, as we saw last week? So there's a lot of questions, but yeah, I think and that's why I find very interesting is looking at the guidance of these companies. For example, on the 12th, when the Spanish CEO of ThyssenKrupp, he happens to be Spanish, when he delivers his report to both the analysts, to the market, and to shareholders in terms of, as I mentioned earlier, how well have we done? What did we get right, wrong? What do we see as a problem? Are we anticipating issues? And sometimes you have great results. I mean, this is one of the big counterintuitive conundrums that is facing markets at the moment and investors. You have a great set of results. You knock the ball out the park with earnings and estimates and revisions, and you have a great guidance, and yet your share price goes down 5% that day. I actually want to write a piece on this because there's quite a lot to be said about it, because people get flummoxed. They go, this has got to have to go up, and then for 3 days it just slides left, right, or sideways. So there are some counterintuitive forces at work that sometimes blow the best laid plans out of the water. And I think that's where a structured note is important. If you were buying these stocks as an individual single item into your portfolio, then you have to question, okay, I'm buying them for growth. Can that growth be sustained? If these stocks go sideways for the next year at 90%, well, we'll Autocall and we'll get all our coupons out. We don't really, that's a bit of a structured note. We're not looking for the accumulated growth exponential. And if it is a growth note, it's capped at a certain coupon, semi-annually or quarterly. So it's a different sort of mindset that one has to take when looking at a note or buying a particular stock for a segregated portfolio. If you had to say to me, choose one of those four for my portfolio, there'd be a completely different discussion, because I'd have to say, well, what are you looking for? Is it growth? Is it defense, pardon the pun? Is it some more defense? What are we actually looking for? Is it a dividend payment? There's different considerations that need to be taken. With a structured note, it's a package that you can't really break out of. So, and that's what we always say. If one of those four companies has to go stratospheric into 230%, we don't get the 230%. We capped at what the contract says, which is 17% per annum, assuming everybody else is behaving. So, but where do we lose that upside? We buy the downside protection, that if anything had to go wrong at the last term, that we've got a 40% degradation across the board. So it's a different discussion, and hopefully it does bring some sort of context to your question.